Okay, so here's an example of the overall audit strategy of three different audits. So we have Angela as a new staff auditor, and she is on her first three engagements. She's assigned to perform the test of controls for acquisitions and payments, and then the test of details of balances for accounts payable. So these are all audits that she's assigned to. So her first client is a medium-sized company. Extensive tests of controls were performed for the acquisition and payments. Fairly extensive substantive analytical procedures were also performed. The test of details of balances at year-end accounts payable were minimum, and there were no confirmations actually sent out. They're not required for testing of accounts payable. Then audit two, the company's also a mid-sized company. Extensive tests of controls were also performed, but after these tests were completed, additional substantive tests of transactions were performed. Extensive tests of the year-end accounts payable balance were performed, although no confirmations were sent out. And then audit three, although the auditors gained an understanding of the internal control, no test of controls were performed over the acquisitions and payments. However, extensive substantive tests of transactions were performed, and confirmations were sent out as a part of an extensive testing of the year-end accounts payable balance. Although this company was smaller than the first two companies, the total audit time spent on testing accounts payable was greater than that for the first two audits. So then Angela, again, who's brand new and she's doing the same thing for these three different companies, does not understand the apparent inconsistency of the three audits. So she's blaming like the partner in charge. Well, this must just be that partner's decision. So then what it asks us to do is to match these three descriptions with the audit. So the first one says extensive reliance on controls was planned for this audit engagement, but the control risk was increased after the test of controls. So they planned on auditing the test of controls, and had it shown that things were great, they probably would not have had to do additional substantive tests. But after they ran the test of controls, they then had to do more. So they must have uncovered some sort of abnormality. So that would be audit two. So it's a mid-sized company. They did the extensive test of controls. However, once it was done, they then did additional substantive tests. So something in the test of controls must have indicated to them that there was some reason to test those further. So they were not comfortable with it. So the control risk was increased after doing the test of controls. So that would be audit two. Then the next engagement says this audit is likely for a public company, and it is also probably the most efficient of the audits. So that's going to be audit one. So they did an extensive test of controls, and then they did a fairly extensive substantive analytical procedures. Again, the analytical procedures are the cheapest and the easiest. Then when it came time to test the details of balance, they did minimal work. So that means they got very comfortable relying on those tests of controls. They did some analytical procedures, again, to see if there was anything that jumped out at them, and it did not. So then both of those things reduced the risk, and they did not have to do as much year-end testing. So that would be that client. Then our third one is obviously audit number three, and it says this company has ineffective controls, and there may also be fraud risk present. So in this case, they knew it going into it, okay, that this company does not have a strong internal control process. So they're not even going to waste any time or money testing it. They're going to move right on into the substantive testing of the transactions and do extensive tests there. And then at that point, they probably still did not feel comfortable, or maybe there were even red flags that they've thought, okay, now we got to take it to the highest level, which is to confirm those year-end accounts payable balances and do very extensive testing so that they can feel comfortable. So again, there was probably some sort of a red flag, and then the auditors can choose to not do the internal control structure or the internal control testing if they feel like they're not going to rely on those at all. It's just a waste of their time and money. Then it asks, well, what other factors could explain the differences between, again, we're two of these audits are of the same similar sized companies. We're in the same accounts payable function. So what else could do it? So like materiality of that accounts payable balance. So possibly in audit 1, maybe the balance was fairly immaterial. Maybe audit 3, it was a very large balance, a very large liability that they wanted to get definitely comfortable with. It could be an initial audit, like you've never audited this company before, versus a repeat client. So like up here, if it's a repeat client and you've been auditing them year after year after year, nothing has changed in their acquisition and payment cycle. You were comfortable with it last year, you're comfortable with it this year. There's no reason to raise that red flag. What if it's that initial audit and maybe you got the work papers from the predecessor audit and they showed issues in accounts payable or they showed issues in these acquisitions? Then maybe you're down here in audit 3 where you're going to do a very extensive testing of those balances because you're not at all comfortable with this client. Maybe maybe as you were doing analytical procedures, you saw a major red flag that made you not comfortable. So there's some sort of unusual transaction that happened in there. And again, you want to dig in a little deeper. Or maybe it's just even the integrity of the client. So like client number 1 could be just an awesome business that is hugely successful, has great integrity. It's run by the best president and the best board of directors. Maybe this company down here is involved in lawsuits and has some bad reviews and it's just a little bit more questionable. So then you just aren't gonna just say that these internal control structures are fine and I'm not gonna test balances. They're gonna want to test the balance. And then finally, what could have, maybe training for Angela, maybe the audit manager of each one of these audits could have explained to her, hey, this is a unique scenario because, or this client we've had forever and we were real comfortable with them. This client, we uncovered some questionable stuff, so we're really going to test it. They could have just explained to her the scope of the audit and the reasoning for their different approaches, but they did not do that, but they could have. Okay, then another question I want to cover is this one here where we've got 3 different audits. So we have audit A, B, and C. Audit A has ineffective client internal controls. So their internal control processes are not necessarily to be relied on. The auditors are not comfortable with them. Audit B is the other side of that, very effective internal controls, and the auditors are relying on those and they do feel comfortable with what the results are coming out of their systems. And then audit C is in the middle, so somewhat effective. So we've got some evidence decisions, and then what they want us to do is to match these evidence decisions with whether it's audit A, B, or C. And then it also asks in this first question, okay, so explain why audit B represents the maximum amount of reliance that can be placed on internal control, and why can't all audit assurance just be obtained by doing test of controls? So if we do a test of controls and say, hey, everything is ticking and tying out, their controls are great, there's, they're running super smooth, well, we won't even do any other testing. You can't do that because, again, the goal of the audit is to say, hey, these financial statements are free from material misstatement. So just because their processes are running smoothly can't guarantee you that. So the auditors still have to do those detailed tests of account balances, like confirming accounts receivable, confirming cash, being involved in the inventory count, things that, are going to roll right up into those financial statements. So that's why we can't just do that. Okay. Then we'll get into matching them. So for number 1, we have the auditor decided it was possible to assess control risk below the maximum. So we're saying that they either have very effective controls or somewhat effective controls. So that would be B and C. So B and C would be they can assess that control risk below the maximum. Number two, the auditor identified effective controls, but they also identified some deficiencies. So then that's somewhat effective. So we recognize they have controls, but they're not perfect. They're not running super smooth. There's a couple of issues here and there. So again, it's not B because B is very effective. C is somewhat effective. Number three, the auditor performed extensive positive confirmations on the balance sheet date. So we're doing very extensive detailed testing of the balance. So that would be for audit A. The client that has the ineffective internal controls means we're not relying heavily on those. We might not even waste time testing them. We might get into more of our substantive tests or our tests of the details of the balances. So this is a test of the detail of the balances. So that would be A. Then number four, we have the auditor performed test of controls. So that's going to be B and C. Again, audit A, they may not. If they've already deemed that their internal control processes are ineffective, they most likely will not waste their time testing them. They'll just get right into testing the actual transactions and the details of the balances. Then five, the auditor performed extensive test of controls and then minimal substantive test. So then that would mean it's the one that it's B, it's the one that has very effective internal controls. So if they have very effective internal controls, they can minimize those substantive tests because they feel comfortable relying on the test of controls. Then number six, the auditor performed substantive tests. So for all three of these audits, the auditor should be performing those substantive tests. So those are the tests that go through the transactions. They come after the internal control assessment. So all audits should have the substantive tests performed. Okay, then we have the audit was the least expensive to conduct. So normally the companies that have the very efficient internal control systems are going to be the least expensive to conduct because again, we can rely heavily on those, which will reduce our future testing, and the testing is where the money comes in with an audit. Okay, then our last one is the auditor confirmed accounts receivables at an interim date. So not year end, because again, year end, it would be all of them. At an interim date means, okay, we're going to pick like quarter ending, third quarter ending date. Let's confirm those accounts receivable. So that's going to be for the two that are have a little less. No, actually, I'm saying that in reverse. I apologize. It is for the two that have the more effective internal controls. So it's B and C. So the one that has the ineffective internal controls, we're not going to do it at the interim. We're going to only do it at year end because our goal is to say that these financial statements are free from material misstatement, and that is on the date of the balance sheet. So the one that's ineffective is going to not do any interim testing and just extensive year-end testing at the balance sheet date. Okay, so that is, kind of again, looking at three different types of audits and how does that impact our audit approach.